Hello everyone, my name is Lexi Head. I'm a managing director and founder of Mercer Wealth Management. I have here with me my business partner and founder, Todd Mercer. We're excited to have you today for our first video cast. For those of you who don't know, we started our firm back in December, and in February we moved to our new office space. We're located now at the Flash Cube building on Hurstburn and Shelbyville Road. And we're excited to be here. Today we're going to be going over our 2022 market outlook. This was a seminar that we did back at the end of January. If you've worked with us, you know that we do an outlook seminar every year to talk about what we see in the year ahead. I will say that this is the first year that I feel like we've really hit almost everything on the spot. And so, a lot has happened in this first 6 months of the year, and we thought it was really important to just kind of go back over where we stand halfway through, kind of what we saw, what we're doing, and get this out to as many people as possible. So to get started, we're going to go over our 14 predictions. Todd?
Okay. Thanks, Lexi. Bear with us. Those of you who've worked with us for a while know that I have done this Outlook seminar probably for the last 15 years, going all the way back to UBS times when we had the great financial crisis. And so it's become a tradition for us to do it at the end of January each year to let you know what we think is going to happen. And wow, what a lot has happened. And this year was probably the boldest prediction that I have made in the last 14 years since I've done it. And if you know me and you know Lexi well, you know that sometimes she's usually half glass full and half glass empty, and I'm usually half glass full. This year we switched roles, and it took me a while after 9 years of working with Lexi to convince her that, hey, this is really happening and this is really a major change. There is a saying in our business that says, don't fight the Fed because you will lose. And what has happened the last few years is that the Fed has essentially had easy money policy, except for 2018. And even though there are a lot of things that affect the market, the biggest thing that affects the market is what the U.S. Federal Reserve does. And so the Fed early this year, or late last year, had announced that they were going to do a major policy transition, and they were going to start tightening the money supply and raising rates. They had previously said they weren't going to do that until 2023 or 2024, so they sped up the timetable substantially, and we're going to get into details about why that is. But so the predictions that we made, and a lot of people were really shocked because, again, I'm usually very optimistic about the markets and I'm a stay the course type of guy, but that's when we have easy money policy, or at least the Fed's not got tightening policy. And so one of the things we said was we would have a possible recession at the end of the year or in 2023. I've actually stepped that up to say that I think we might be in a recession now. At the end of last quarter, we had negative GDP of 1.4%, and I really don't think anything's going to push that into a higher GDP for the second or the third quarter this year. We said U.S. markets would struggle and possibly have a negative year. If you've met with us or you attended our Outlook, I said that I thought they would have a negative return. I just didn't put that on the slide. Now I'm for sure they're going to have a negative return, and it's going to be well into the double digits. We said global markets and emerging markets would struggle, and that's happening, and I think that's going to continue to happen. Again, if the U.S. catches a cold, Europe gets pneumonia, and the emerging markets get cancer. We said energy prices were going to increase. That's definitely happening, and we're going to get into some more detail on that. But with current administration policy, we don't see that changing. We said commodity prices were going to increase, and they have, and we think they'll continue to increase for the foreseeable future. We said interest rates long and short would rise. That has definitely happened and happening, and going to continue to happen to get inflation under control, which is next on the list. Inflation is going to remain an issue. And it's going to remain an issue for the foreseeable future because the Fed is way behind the power curve at raising rates and tightening the money supply to tame inflation. We said the dollar may weaken. That's the one thing I think we've missed, and part of that is because of the war in Ukraine, because the U.S. is the safest place to invest, and our interest rates are higher than the rest of the world right now. So the dollar is we reversed our position on that. We're allowed to change our mind if things aren't working out. So we think the dollar is going to continue to strengthen against other global currencies. We said the unemployment rate would steadily fall, but then later in the year we would have issues with the labor market. There's already been some cracks in that. Some of the major CEOs have announced, especially in the tech sector, that they're considering layoffs or labor force reductions. Consumer and business confidence are starting to fall. That has happened, and it's continuing to happen. Corporate earnings are going to be good through the end of the third quarter, and then are going to be affected by inflation. And we've seen that with Target and some other companies recently where they said inflation is substantially impacting their bottom line. We said there would be gridlock in D.C. I think that's a no-brainer prediction, at least until the end of the elections, and maybe until the Biden administration changes hands, or until Congress changes hands again. We said COVID was still going to be an issue, and it is. There's a new variant out, and COVID is spiking again. What's interesting is on that, the testing is most people are not getting tested, or they're not reporting their home tests. And so the way that they're predicting COVID is through hospitalizations and through wastewater management now, not through the testing regime. And we said there was going to be a volatility again, and again, we predicted that correctly.
Yeah. So typically when we have a big market correction, there tends to be kind of one factor causing it. I think there's a lot of different things that are causing pressure on the markets right now. But if you really get to the heart of it, I think the biggest issue is inflation. So can you talk about the issue we're seeing with that?
Yeah, so inflation was pretty benign up until January of 2020, January of 2021, and then we started seeing it slowly creep up in early 2021. And you can see from this chart on inflation, it went from 1.4% in December of 2020 to 1.7%, and steadily increased. And the print yesterday was the highest inflation's been in 40 years. For last month was 8.6%. So the inflation is definitely is causing a lot of the issues. That's the major factor that we're seeing is what's causing the economic crisis we're having right now, or economic conditions we're having right now. Here's the second slide. It talks about, again, I just said that inflation's been pretty benign. The Fed target rate's been 2% for decades now, and you can see here that until just recently, the Fed has done their job fairly well and kept inflation tame at that 2% level. You can see a little bit of inflation back in 2008, but of course we had deflation after that during the financial crisis, and so we've maintained that level. Here is the reason why that we've seen the inflation. It's the first time this has ever happened. This is a chart of M2, and M2 is essentially known as the money supply. Every day, everything from 30-day treasuries all the way to coins in your ashtray. And what you can see here is going back to Alexander Hamilton time, I guess, when we started the federal bank. We've had a 30% increase in the money supply in the last 2 years, since March of 2020, when they passed the first COVID Relief Act. And so we've added $6 trillion to M2. That's a substantial increase in the money supply. The definition of inflation, textbook definition, if you took economics, is too many dollars chasing too few goods. And that's what we're seeing here with inflation. Here is a better chart of M2 just in the last 5 years, and you can see that M2 has gone from about 13 trillion to, again, $21.5 trillion in the last 5 years. So what you can see with that is you can see that when you spend $6 trillion, you get something. And so this is the GDP back quarters for the last 5 years. You can see up until COVID hit, we had pretty good GDP through the last few years of the Trump administration. And then, of course, we fell off a cliff with COVID because of all the shutdowns. And then finally, you see once we start spending the relief money, you can see GDP shot up 33%. And then we had really good GDP through last quarter, and then it fell off the cliff in the first quarter, down negative 1.5%. And we're going to talk a little bit more in detail about why that is.
So the Federal Reserve has what's called the dual mandate. So the two parts of that are to keep prices stable, and then also to sustain maximum unemployment. We've talked about that the target inflation rate is 2%, and we're clearly running quite a bit higher than that. Can you talk more about the policy actions that the Fed is taking to kind of get a handle on the inflation issue?
Thanks. The Fed has two ways that they control inflation. The first way is setting the short-term interest rate, the Fed fund rate, which that's this chart here. And then the second way they do it is through open market operations, buying and selling bonds, essentially controlling the money supply, which we just talked about, M2, adding or subtracting from the money supply. Both of them really slow the economy down. I guess one would be, you could look at it like a sprinkler, which would be the rate, Fed fund rate. And the other is like a fire hose, which is like the controlling the money supply. And so under the dual mandate, what you're supposed to be able to do is to take the Fed fund rate and subtract it from the current inflation rate and get the target inflation rate. Well, as of today, the Fed fund rate is 75 basis points. We may get later this week. There's been rumors, that's why the market sold off today, that the Fed may increase interest rates on the short term by as much as 75 or a full point, which we haven't seen that going back to the 90s when they moved rates substantially more in bigger increments as opposed to 25 basis points. This rate on this chart, what you can see, the gray bars are recessions. The blue line is the Fed fund rate. And what you can typically see is the Fed will move interest rates up and down, and what they typically do is they keep rates too low for too long, then they raise them too quickly and too high, and it kicks us into recession. There's been 12 recessions post-World War II. 9 of them have been caused by hard landings caused by poor Fed policy. The only one they really got right was in 2018, where they backed off. If you remember, 2018 was the last big market correction or market downturn pre-COVID, and the Fed was pulling money out of the money supply and raising rates that year, and the market was down about 6%. And when the Fed stopped in 2019, the market recovered, and the economy was really doing well in 2018. But again, don't fight the Fed. The second chart here shows, again, the second way that the Fed essentially controls interest rate, and that's through open market operations where they buy and sell bonds. Essentially what's been happening for the most part, except for 2018 in the last 14 years, is the Fed has been essentially printing money, send it to the Treasury Department. The Treasury Department sends bonds back to the Federal Reserve. The Federal Reserve parks them on their balance sheet, and they create money out of thin air. What's happening now is quantitative tightening. The reverse of that, when the Fed has bonds come due from the Treasury Department, they send those bonds back to the Treasury Department. The Treasury Department has to take money out of their checking account and send it back to the Fed, and now that money's out of circulation. And I'm going to talk about how damaging that is to the stock market, where it comes about here in a minute. But essentially, that money comes out of circulation. It's got to come from somewhere. It typically comes from high-risk stocks or high PE stocks. And also, the other thing it does is it encourages investors to move to the Treasury market. And what you can see here, again, the gray bars are recessions. The blue bars, or the blue line, is the 10-year Treasury, which is kind of the gold standard for the bond market. And you can see by the little red mark where we were in January when we did this. We're about 1.5, a little over 1.5% on the 10-year. Now, today we hit 3.4, I think, by the end of the day. So more than double on the 10-year Treasury. And we attended a conference today via Zoom, and chief economist from Blackstone, who is one of the private investments that we're using, and he's thinking that the 10-year by the end of the year would be north of 4 or 5%. And just to illustrate what's going on, this next slide, this is the reverse of what happened that I showed earlier with the trailing of M2. You can see here, slowly since January, you can see where the Fed is reducing the money supply, and they're going to reduce the money supply by somewhere around that neighborhood of $95 billion a month. And to put that in perspective, what's happening as the Fed pulls that money out at $95 billion a month, that's almost $1.2 trillion coming out of the money supply. The government has to go borrow that money from the open market. And they also are deficit spending because we're not collecting enough tax revenue. So it's not a one-for-one where they're just not getting the money from the Fed anymore. They've got to go out and borrow the money to pay the Fed back, plus they've got to borrow additional monies to fund the government operations since the Fed's not doing quantitative easing anymore. So it's a $300 billion turnaround for the Treasury Department, and that's why rates are shooting up on the long term so much.
It definitely has an impact on things. One of the other things we're seeing right now are higher energy prices. So I think most consumers are, feeling that in terms of their pocketbook at the pump. Historically, we've seen a correlation between higher energy prices and the stock market. Can you talk a little bit about that?
Yeah, as I said earlier, there's been 12 recessions post-World War II. 9 were caused by Federal Reserve policy, and 2 were caused by oil shocks. And what this chart shows is oil prices essentially going back by the barrel to World War II. And you can see in 1972, we had an oil shock, and it caused the recession, the Arab oil embargo. And then, of course, in 1990, the Persian Gulf War, we had oil prices spike substantially. and that kicked us into a recession, among other things, during 1990. So at the same time, the Fed, if you go back to the Fed fund chart, the Fed was moving rates at the same time, increasing rates. So it was a dual hit to the economy, especially to consumers. You had higher interest rates, higher energy prices, and then a tightening of the money supply at the same time. If you look at the chart, you can see here oil prices were about 80 when we did this in January, and now they crossed $120 a barrel on Friday. I think they came down a little bit today. I didn't get to see it before we started this, but energy prices are going to substantially continue to increase, we think, because of the lack of production in the U.S. I'm going to talk a little bit more about that here in a second. But I don't see energy prices coming down anytime soon. And if you've seen Jamie Dimon from J.P. Morgan, he's pretty vocal about it. He thinks that oil prices are going to remain low or remain high for quite a period of time. And so here's the kind of elephant in the room, if you would, on that. U.S. oil production. So U.S. oil production, we had almost gotten up to 13 million barrels a day. We need about 18 million barrels a day to essentially fuel America. And we're only producing about 11 million barrels a day. And we haven't got all the oil production back online since COVID. And the administration's policies are not encouraging more drilling. It's very very cost intensive for oil companies to go out and drill new holes in the ground and find new oil, and they're really worried about that. The current administration is going to pull that kind of the rug out from underneath them. If they drill more and spend that money, that capex, and borrow the money to go drill holes, they're not going to be able to recover that. So here's again the effect of that. Wholesale gasoline prices for the first time ever went over $4 a share. Or a gallon, and what you can usually look at that is you got about $4 wholesale price plus about anywhere between 15 to 25 cents to get it delivered to the pump. Plus, most states have anywhere between 20 and 50 cents of taxes on a gallon of gas. So that's how you get to $5 a gallon quickly. So another thing that we're seeing is natural gas prices. They've shot through the roof. Natural gas prices when Biden took office were about $2 a cubic foot. They're north of $8 and probably on the move to $10. And again, because frackers don't want to go out and essentially drill new holes in the ground because they're worried about the administration's policies.
So one of the other questions that I get a lot from clients is related to the housing market. We've seen houses continue to rise in value quite significantly over the past couple years. And so a lot of people worry that we're going to see a bust like we did in the financial crisis. Mm-hmm. Talk a little bit about what we think we're going to see with the housing market.
I don't think you're going to see a crash in the housing market like you saw in 2008. And this chart essentially illustrates that. We need about 1.5 million homes or housing units, apartments and houses, condos, etc., to take on net new household formation and to take on immigration, new homes for immigrants, and to take care of the houses that fall out of the market, either blow down, burn down, fall down, whatever. And so since the financial crisis, we've only been building on average about 1.3 million housing units a year. So we're short almost 200,000 a year. That means in the last 14 years since the housing bubble in 2008, 2009, we're short about 2 to 3 million houses. The cost to entry in building houses and subdivisions is a lot higher now because of bank regulations, and then the number of builders and contractors out there is a lot smaller as well. So then you add commodity prices on top of that, rising commodity prices. I don't think you're going to see housing prices collapse. I think we're going to see a pause here because of rising interest rates. But if you need a house, you need a house. If you got to move out of your parents' basement or you got to move out of your dorm room because you graduated from college, you got to go somewhere. And if you didn't know this, the largest part of the population now is not me or is not my parents who are baby boomers. It's you, and it's our other folks that work on our team like Rachel and Taylor who are Generation Z. So the millennials, people under 40, the millennials, and Generation Z are the largest part of the population. And you guys are buying your homes and some of your second homes and apartments, and there's a huge demand for housing. So I don't think that you're going to see the housing market collapse for the foreseeable future. I think you will see it slow down. I think you'll see a pause in housing prices, maybe come down a little bit in certain geographical areas, but I don't see a collapse in the housing market.
So we've talked about inflation, but the other part of the Fed's dual mandate is sustainable maximum unemployment. And so one of our predictions at the beginning of this year was that we thought that the labor market would remain steady, but as time went on, we might start to see some issues with it. So you kind of hinted towards that when you went over our predictions, but let's talk a little bit more about what we think we're going to see there.
Yeah, I think as business confidence falls, and us as business owners, I mean, we look at it and go, okay, well, do we need to add more staff? We may say, well, we may not need more staff. We may just work longer hours or may do more with what we have as opposed to adding people. And so that's really, there's 11 million unfilled jobs in the country right now, or 11 million plus. And I think a lot of those jobs are going to dry up for two reasons. One, I think employers are going to say, well, sales are down, revenues are down, we don't need to add these people now. Then the other thing I think is people are doing, we're seeing a lot of changes where people are automating jobs. If you've been to a Chick-fil-A recently, most people that go to Chick-fil-A, they don't talk to a soul. They use their app, they order, they show up, they pay for it with their app, and they either go through the drive-thru and pick it up, or they park in one of the parking spaces and pick it up. So the UPS, Amazon, FedEx, and a lot of their companies are going to robotics and using automation, because if you have a robot, they show up on time. They don't need a coffee break or a cigarette break or a lunch break or vacation time or anything else. So I think you're going to see a lot of tech companies and a lot of other companies in the service sector potentially that are going to be replacing workers with automation somehow, and as the economy slows, those jobs are going to dry up. This chart essentially shows from the pandemic where we had a big spike in unemployment, and you can see we're back down to where we're over full employment. Really, we're below 4%. We're at like 3.6% right now. The U6 number, which is people working in their profession, which is the blue line on this chart. The gray line is U3, which is anybody working part-time. The blue line is U6, which is people working in their profession full-time. That's still pretty high. That's still in the 7% ratio. And I think this is the reason why that is. People are still resistant to go back to work. This is the labor participation rate. And a lot of people have talked about this. We're at one of the lowest participation rates that we've been in for the last 40, 50 years. Since the pandemic, and people were getting unemployment benefits and child benefits, and they were getting stimulus checks and that kind of stuff. And it really encouraged people not to go back in the labor force. And so the labor force participation rate, there's about 160 million, give or minus 5 or 10 million people in labor age, our age, are from 20 to 65 or 67. And that number is the smallest it's been in decades. And we really need people to get back in the labor force. If they don't, jobs are going to get automated and replaced.
So one of our themes for the year, not necessarily one of our predictions, but one of our themes for the year was that there would be some sort of geopolitical issue that would have an impact on the markets. We didn't know what it was going to be or when it was going to happen, but we knew that there would be something. We've really seen that play out this year early on with the war between Russia and Ukraine. So talk a little bit about the impact on that going forward.
Well, one of the things that you hear a lot is the Putin price hikes, and that is probably a little bit true. But if you go back to the inflation chart, we had 7% inflation in January before Putin invaded Ukraine, and so 90% of the inflation was caused prior to the invasion. That has exacerbated definitely in the energy markets, and it's really putting a strain on Europe, and it's causing the global energy markets to really take a shock to them. The other thing that we're seeing is with what's happening with globalization is probably being set back 10 or 15 years, because we can't go to Ukraine. A lot of countries can't go to Ukraine and get food. There's a prediction of a major food crisis that's coming, and that happened in 2015 when Russia invaded Crimea and destabilized the region. There was a major food shortage in 2015. I think that's going to happen again. Lithium, nickel, natural gas, oil, all these things that were coming out of Russia and coming out of Ukraine can't come out anymore. And so we're going to see a major setback in globalization and longer inflation because of the war in the Ukraine. I don't see that ending. A theme, it's not ESG friendly, but a good theme that we have added to our portfolio recently is defense spending stocks. There's going to be probably one of the largest defense spending sprees in history going back to World War II in the next 6 years. And just real quick, why that is, again, I guess having a former military officer or two former military officers on your investment team is good in a lot of ways. All the weapons that we've sent to the Ukraine, we have to replace the javelins and the air defense weapons and that kind of stuff. We have to replace those out of our stockpile. Plus, they're still using them. Plus, the rest of the countries that are NATO friendly have sent the Ukraine weapons as well. So there's a massive amount of weapons that have to be replaced. Plus, we have to have our own weapons for training. And if you were anybody buying Soviet-made equipment or Russian-made equipment, you kind of don't want it anymore. And so there's a big demand for the former Warsaw Pact countries to buy our weapon systems, and as well countries that were buying Russian systems. Now they've seen how they've performed in the battlefield. They're not real happy about having them. So the U.S. defense stocks, or the U.S. defense industry, is going to really benefit from the war in Ukraine.
So I know a question I get a lot from people is, why didn't they move quicker on inflation? Why didn't they see this coming? And I think if you watched the news, one of the terms that you would hear is that they thought it was transitory. They thought that some of the inflation would clear up due to supply chain issues resolving that were a result of the pandemic. And so if we look at some of those supply chain issues, they're still having an impact on things. One of the biggest areas we've seen that is with semiconductors. It's had an impact on all industries, but if you look at the auto market, you've definitely seen the impact there with chip shortages. So not a huge factor in what we're seeing on the markets, but talk a little bit about how we think this is going to play out with semiconductors going forward.
Yeah, I think the semiconductor demand was essentially from COVID, from the work from home thing. I mean, we as a team, 10 computers and monitors so that we could work from home better, systems. And so there was a huge demand not only for us, but for everybody in our industry and other industries to buy that, which caused this massive shortage of semiconductors. You couple that with the shutdowns in the factories in China and other places where they weren't making the semiconductors, supply and demand. You had a shortage of supply and an increased demand, and we ran short. This chart is actually kind of interesting. We had a different chart when we did this back in January where semiconductor demand was still pretty high, and this shows essentially the cost of semiconductors and the demand. So you can see early on in COVID where the demand substantially ramped up, and now it's kind of leveled off. And so we're probably going to see semiconductor demand fall. And the other thing I think you're going to see, going back to the other slide, is, again, reverse globalization. It's already been announced that Intel's building a huge semiconductor plant in Ohio. Apple's building a huge plant even before COVID to build iPhones back in this country. A lot of production of that kind of stuff that was shipped overseas, either to Asia or even into Russia or Ukraine or other areas like that, Central Europe, is coming back on shore right now because it's a national defense issue, really. Mm-hmm. So I think you're going to see a lot of these supply chain issues come to an end as the economy starts to slow. And again, I think you'll see some deflation in those areas.
So we've talked about a lot of different factors that are impacting both the stock and the bond markets pretty significantly with a lot of volatility. This past April was the worst month for stocks since the pandemic hit in March of 2020. And it was the worst April on record since 1970. Can you talk a little bit about, just what you think we're going to see with the market the rest of the year?
Yeah, it's interesting. If you watch CNBC, which we do, and Bloomberg and Fox Business News, and read multiple newspapers, Wall Street Journal, USA Today, other trade journals, and listen to all kinds of economists, you really don't hear, people are really not willing to make the bold prediction about a recession or about a fall off in the economy. Well, I'm pretty plain spoken, as everybody that knows me, but I went out and looked the last time that something like this has happened. Mm-hmm. And essentially the last times we've had what I call the planets aligning like they are right now, with inflation, rising rates, the Fed pulling money back out of the money supply, increased oil prices, geopolitical tensions, domestic politics a mess. And that is the NASDQ, essentially the history of the NASDQ going back 45 years. The times that you've seen times like that are 1990, Persian Gulf War, and also the savings and loan crisis. We had a pretty bad recession then. The 2000, where we had the tech bubble, and then 2008, where we had the financial crisis. And what happens is these things expose a major weakness in the economy. The other time we talked about earlier, 2018, we really had a soft landing because, again, the Fed backed off and we didn't have inflation like we've had right now. So those 4 years are the times that you've seen it. And what you can see is, if you look at this chart, you can see in 1990, the NASDAQ sold off like 36% almost. In 2000, during the tech wreck, the NASDAQ sold off 80%. It took 14 years for the NASDAQ to recover, if I remember right. And then in 2008, 2009 timeframe, the NASDAQ was down 55-60%. So this chart essentially shows when we did this and warned everybody, and people that came with us to the new firm, they got out either while they were moving or shortly after moving out of QQQ, the NASDAQ 100 tracking stock. We sold all our growth stuff that we had. We lightened our load in small cap, mid cap, and other investments, and that really saved people a lot of losses, or a lot of loss that they've built up over the last 3 years. And this chart illustrates that the NASDAQ was almost at 16,000 going into this year, and now we're down today, I think, north of 32%. So I think that's not over. I used this analogy earlier. We had our investment meeting this morning, and I used that analogy. If you're a ship and you see a hurricane, we're in the front part of the hurricane or just have entered the hurricane. We are not gone through the eye or the other side of the hurricane yet. The Fed has just started the cycle of rate tightening and quantitative tightening, and it's going to go on for a while because they're way behind the power curve. So I would not be surprised if you saw the NASDAQ down. I said this a couple weeks ago when we were practicing for this, or when I was updating the slides for this. I said I thought the NASDAQ would be down 50% or more this year. And again, that prediction doesn't look so bold now at this point. And again, because I think we're at the beginning of this, not the end. So here's another chart just real quick on the NASDAQ, a little bit more detail. This is a 45-year history that goes way back. And this kind of illustrates more those years I was talking about, 1990, the 2000 and 2003 crisis, and then 2008 crisis. And I think we're headed for that again. And I think it could be a multi-year crisis. So.
Well, one of our predictions, I actually think it was our very last prediction, was that we would have increased volatility, or we said volatility again. With the volatility that we saw with the pandemic, things bounced back pretty quickly. I think we've kind of stated we don't think this is over. We don't think this is the same situation. So the next question we usually get from people is, well, how do you know when to change course? We've taken these precautionary measures. When do we change course? Can you talk a little bit about volatility and what we look for to kind of shift gears?
Well, 100% of the time, if you look at this is a chart of the VIX, or the Volatility Index, and this essentially shows you when the times to invest. Again, gray bars are recessions, and the blue line is the Volatility Index, and you can see the last major recession we had that was caused by the COVID shutdowns. The VIX got over 70, and that was the time to pull the trigger when the market was down 36% sometime in midsummer. And people that did get in the market then really made a lot of money. Now we're starting to see that volatility. The Volatility Index usually hinges somewhere between 15 and low 20s. We've been averaging in the 30s recently, and we've also had some strong bear market rallies, and you get some of the most strongest rallies during bear markets. So I think our team thinks that we need to be in safer stuff, and when the VIX gets over 50, that's when we might start looking, depending on what the economic factors are, going back into tech again. I think there's going to be an enormous opportunity to back into tech again in probably 18 months or so.
So if all of this wasn't enough, it's a midterm election year. And, in addition to our regular annual market outlooks, we also typically will do seminars about elections in, election years or midterm election years. And what's really interesting is there's definitely a correlation between election years and the stock market. So
For sure.
Why are we concerned that this is a midterm election year?
Well, they tell you in sales, don't talk about several things: sex, religion, and politics, because you're going to lose or you're going to make somebody mad. But I always like to say that we're agnostic with politics when it comes to managing money. So I want to put that caveat out there first of all. But this chart essentially shows every midterm election year going back to 1962. So pretty far back, 50 years. Now, it doesn't show 2018 because I couldn't get a chart that showed it yet. But 2018, the S&P was down about 6%. So again, as Lexi said, if it's not enough, the war in Ukraine, rising energy prices, rising natural gas prices, rising interest rates, the falling stock market, now what? Well, 100% of the time since 1962, every midterm election, the market's been down, most of the time double digits. That's a pretty good indicator that you're probably going to see the market down again. And then again, I have the kind of the pendulum of politics that I call it. The markets, politics swings right, then back left again, and I think we swung back left, and now I think we're swinging back right. But that causes a lot of anxiety with people, and especially with business leaders, because they can't make plans, and that's why the market rolls over until they can get closer to plans.
So we've already kind of hinted to it, but I would say that we made some pretty bold calls back at the beginning of the year. And we did adjust client portfolios, aligned with those kind of bold predictions that we had. We talked about how we sold out of those growth positions. And we've really been working around the clock with clients to make additional changes to their portfolios since then. So let's talk a little bit about how we've actually been positioning people.
Yeah. So we did, again, this slide is from our seminar back in January, and it was done. I put it together early in January. And this is how I recommend positioning. Again, this was kind of a bold call. We said, depending on what your needs are and your age and requirements, to be 20 to 40% in long quality equities. And I'll talk a little bit more about that here in a second. 20 to 40% in alternative investments, which we have not done a lot. And for different reasons, we have not done a lot in the past. And then 20 to 40% in cash or short-term hybrid fixed income securities that don't really take on a lot of interest rate risk. And so we had a lot of painful conversations, if you recall, in January, and then in March and April and February, because people had a huge capital gains, and people don't like paying capital gains tax. But we had discussions. I said, well, you can either, if you have $2 million of a portfolio, you can pay, and you're up 100%, so you're up $1 million. You're going to pay in Kentucky $250,000 of capital gains tax. If the market goes down 30%, you're going to lose $600,000. I'm not real good at math, but $250 seems to me less than $600. Plus, if you're in cash, you can't lose any more money, or if we reposition you. So when we positioned it that way, clients said, well, that's a smart way to think about it. So we've had a lot of really happy clients because they haven't lost that 30% like the NASDQ has lost. And so, and we've moved to real estate. We moved to private debt. And we moved to some other private equity investments, which we can get into some more detail here.
So one of the benefits of being independent and working at our new firm is we have a lot more investment options available to us. That was one of the struggles that we had at our prior firm. We knew that this was coming at some point. Last year we didn't know it was going to happen quite this quickly with the Fed moving, but we were already starting to kind of get a game plan and start to slowly move people towards alternatives, and we just didn't have a lot of options available. I think that's one of the best benefits of being independent and the new firm. But like you said, a lot of people aren't familiar with what alternative investments are. So why don't we talk a little bit about the different types of alternatives and the types that we're actually using in client portfolios?
Yeah, so most people are familiar with, long-only stock and long-only bond. Either you own different types of stocks to be diversified: international, small cap, mid cap, emerging markets, large and small, or large and small cap, or large cap growth, large cap value. And that's traditionally what we've done. Again, kind of keeping it simple. And again, in a bull market where the Fed has easy money policy, that's where you need to be safe. But in a bear market like we are now, you really need to go other places to get returns. And so these are the 7 types of alternative investments, big categories: private equity, private debt, hedge funds, real estate, commodities, collectibles, and structured products. We're not going to sell you Sikorsky Crystal or Beanie Babies or collectibles or art. And I don't like structured products because I don't think they do what they're supposed to do. I think the sponsors make a lot of money, the advisors that sell them make a lot of money, but I don't think the clients really make a lot of money. And so we really are focusing right now on, I would guess, 3 or maybe 4 private debt, real estate, commodities, and private equity. I'm not a big fan of hedge funds because hedge funds right now I feel like are not doing what they need to do because they're a lot like NASDQ stocks, high-risk stocks, and people are pulling money out of those high-risk assets to get 10-year treasuries like we talked about earlier, especially on the institutional level. So we're focusing right now primarily on 4, again, private debt, private equity, commodities, and the real estate market. I'm going to show you a real quick slide, kind of a boom and bust slide. We talked about this earlier. Two of the 4 years that we talked about being bad, 90, 2000 to 2003, 2007, 2009, and then 2018. This illustrates 2 boom and bust cycles from August of 98 through May of 18. And essentially the kind of royal blue bars are the stock market. And you can see these wild swings on the chart in the stock market. The green bar represents the bond market. And you can see some pretty good swings in the bond market, but mostly it's just not great returns. The purple is a typical 60-40 portfolio, 40% fixed income and 60% stocks. And you can see how that even has had some wild swings due to the stock market portion of it. And then the turquoise bar is alternative investments. And you see, except for during the financial crisis, they really performed fairly well. But what's interesting in the end is if you look at the total period of time on the far right-hand side, you can see alternative investments outperformed equities for the most part. And they did it with a lot less volatility. And the reason is because they're illiquid and also, or they can be illiquid, and also only usually higher net worth investors get in those, which essentially just defines most of our clients. And there are alternative investments that lower net worth people can get into now. Mm-hmm. So we are some of the we can't really say because of, again, they're alternative investments, specific funds that we're using. But we're using real estate, private real estate. We're also using some select ETF REITs that we've researched, some select REIT stocks that we've researched for those who can't get in private equity, but it's still an alternative investment universe. We're using several ETFs with food and with other commodities. We're using those because we feel like that they are a better place to invest in the commodity markets and more liquid. We're using several different private debt funds that most people can get into that are in our book of business. And then finally, we are using some private equity funds that most people can get into as well. The benefit of being independent, we do have oversight from Sanctuary. We do have oversight from the regulators, but it is a whole lot easier at our new place to do alternative investments than it was at our previous firm. It could take up to 2 months if you did everything right and checked all the blocks to get somebody in an alternative investment. And it was like pulling teeth to get it done. And so it's never easy to do anything good, but it's a whole lot easier to do it here. And the other thing I would say is at our new firm, is kind of a commercial, we have most, if not all, of access to these alternative investments that the larger firms have. Our previous firm, UBS, Wells Fargo, Citibank, those places as well. But we have a lot of access to smaller funds that those firms don't have access to. I sit on the Alternative Investments Committee, and so I'm seeing everything new that's coming out, or the Alternative Investments Committee for Sanctuary. So I sit on the committee, and so I see a lot of things that we have coming that we're going to be on the vanguard of. So it's really exciting. So. Yeah.
Different share classes as well that we didn't have available to us before. So
yeah, and just to expound on that, great add-on. At our previous firm, we could only do the commission-based share class. Now we can do the commission-based share class, which we probably wouldn't do. We primarily do the registered investment advisor share class, which is a fee share class, which has usually a better income better return and better characteristics for the client. So again, putting that as fiduciaries, true fiduciaries now, we can put the client's interest first, and that's a big thing for us. So, well, I'm going to wrap it up.
Yeah. So again, we made some pretty bold calls at the beginning of the year. We're halfway through the year, and we've seen a lot of it really ring true. We made some pretty drastic changes to client portfolios, and we don't think it's too late. If you haven't made changes, if you've kind of dug your heels in and stayed the course, it's not too late to make a change. We do think there's unfortunately more downside from here. So we encourage you, if you haven't met with us or your advisor, reach out, schedule a meeting. We'd love to meet with you and talk through more of the specifics of what we're doing and how we're implementing this across portfolios.
Yeah, I guess I would add one thing to that. If you're sick and you go to your doctor and the doctor says, keep doing what you're doing, you're going to be fine, you're going to get over it, and you keep getting sicker and sicker, you might want to get a second opinion. So you might not take the second opinion, but it's a good idea to have the second opinion. We've been right more than we've been wrong throughout history, and I think this time we made a bold prediction, and I think people that have taken our advice are very happy right now. And again, going back to my hurricane analogy, we're just at the beginning of the hurricane, not at the end of the hurricane. And if you didn't bat down the hatches early, as Lexi just pointed out, you still have time because it's not over yet. So I hate to be so negative, but you really need to look at your portfolio, look at your positions, and I think there's a lot of opportunity out there to do other things. So thanks for joining us for our first video cast. Thank you. So that's the 30s versus the 50s, our first video cast. Look for more of these. Another reason we went independent so that we could do stuff like this, which we never could do before. So thanks again for joining us.